Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. Thanks for our listeners jumping on the call. Well, we had a pretty big 4-day win streak. So if we look at the numbers, we had the Nasdaq Composite rise about 6.7%. And the S&P 500 jumped about 4.6%, followed by the Russell 2000, that small cap area, up about 4.1%. Now, we did see 10 of the 11 S&P sectors finish positive, and that was led by technology up about 7.9%, consumer discretionary up about 6.4%, and communication services or communications up about 4.5%. Now, U.S. Treasury yields, they edged lower as the FOMC officials hinted at some potential rate cuts in June. If we look at crude oil, that slid about 1% due to some potential acceleration in the output by OPEC. Gold futures, they retracted a little bit, came off the high of about 3,500 and ended up about 3,320. We did look at the U.S. flash PMI data, and that did show some slowing business activity growth, but both manufacturing and the service sector still remained above the growth threshold. Consumer sentiment, that improved slightly, up about to about 52.2, while the one-year inflation expectations stayed pretty high. I mean, really high at about 6.5%, spurred by these tariffs. If we look at U.S. housing data, that was pretty mixed with new home sales increased, but existing home sales continue to pull back. Now, we are getting into earnings season, so we did see Procter & Gamble, PepsiCo come out with some profit forecast cuts. They announced some price increases due to some of the tariffs that are being proposed and rolled out. Now, overseas, we had the IMS reduce some economic forecast for most countries, but the U.S., they had the GDP projection at about 1.8% for 2025 and lowered it for 2026 to about 1.7%. And for those 2 years, they had China at about a 4% growth. Now, Germany, UK, they saw some flash service PMI readings fall into some contractionary areas. UK retail sales rose by about 0.4% in March. And the core inflation in Tokyo, now that reached a 2-year high at about 3.4%. But I think the real key here is this week, and it's all going to be about earnings. I think this week we have about a third of the S&P companies reporting. Companies like Microsoft and Meta, platforms and Apple, Amazon, so on and so forth. So we have a lot of earnings coming out this week. So we'll be also looking at some U.S. economic data. We'll be analyzing the Q1 GDP, March employment figures, the PCE price index, some consensus estimates for Q1 GDP growth, and they're coming in about 0.4. Definitely some contraction expectations with the tariffs rolling out. Now, some other U.S. data that will be rolling out will be the ISM PMI numbers, consumer confidence, pending home sales, factory orders. And then we'll get into some international events. Like the Bank of Japan is expected to hold rates pretty steady. We have some elections rolling out in Canada. And then Europe and China, we'll be looking at some PMI numbers, some inflation numbers, some updates on some GDP figures. Jeremy?
Gotcha. Graham, I had a question for you. So kind of still what's going on. I mean, our clients and the listeners here are still kind of maybe a little concerned about what's going on in the markets. Do you have any advice for some people right now, kind of, what they're looking at on a daily basis?
Yeah, I think generally we have to be patient. We have to stay diversified. And we have to look past this, right? We have to say, okay, what is this going to look like 6 months, 1 year, 2 year, 3 years? And the market's going to look different. And if history's any guide, potentially higher. So I think we have to look back, look at our goals and objectives, and kind of look past this. But it doesn't mean that taking a slightly more or a little more defensive stance, especially if you're pre and post retiree, keeping a little extra powder on the sideline, a little extra cash. I think that's a more defensive stance, if you might. I think that's prudent. right? For our younger long-term investments or that portion of the portfolio that's years down the road before you're ever thinking about using it. We want to look past this, stay fully invested, if you might, from that standpoint. Hey, there was one interesting stat that I saw, because everyone knows I love stats. We were looking at the market performance post 100 days. So the first 100 days of a new president's cycle, if you might. So going back to 1949, in the first 100 days, we saw a negative market, S&P 500. And if it was down, we saw basically an average return of about 20.6%. But if it was positive for the first 100 days, we had a positive return of 53%. Now, I don't know if history's any guide. Everyone knows I love these stats. It is interesting to look at and see, are we following some same track and trends as the past, or can we buck past this if we can get some resolution with the tariff talk?
Gotcha. Well, Graham, we always love the stats. We appreciate the expertise, and we thank you for our listeners, and we look forward to seeing you next week.
Take care.